Tuesday, July 9th, 2019, Maneco 64, home of alternative economics and contrarian views. It looks like China is continuing to increase its holdings of physical gold. That's what I want to talk about today, partly. Also want to talk about leveraged loans, which is something I've been covering since late last year, which is a market that's evolving, and in my opinion, it's very risky and could lead to triggering the next financial crisis. I will talk about that as well. There's an interesting article in the FT that just came out about leverage loans. Before that, of course, I'll look at what the markets are doing this morning. Yesterday, I covered Deutsche Bank, of course. Early on, Deutsche Bank stock actually rose quite well. It was up quite significantly. It was at the highest level since May. It traded above around €7.50, but as you can see here in the chart, it turned around and closed below €7 and closed around 6.80. What was the reason for that? Partly, maybe people digested all the overhaul, the plans that they have. One of the headlines I saw is that by eliminating so much of their investment banking arm, they're going to be in a difficult position to generate revenues. Apparently, the German banking sector, commercial banking sector, has very low margins. So that was the story this morning. It's quarter to 8 a.m. London time. So Deutsche Bank is not trading yet, but I will keep you updated if anything happens through tweets on Twitter. So you can follow me on Twitter as well, at maneco64. The stock markets, yes, we broke out last week to new all-time highs, but they seem to be turning around back down the last few days, and they continue to weaken this morning. So where are we right now? Well, we've got spot gold, $13.94.40. That's down $1. Gold's still consolidating here. The low's been $13.90.72 and the high $13.96.70. Silver, though, has been kind of outperforming slightly yesterday and today, which is maybe a good sign. Who knows? Right now, silver's at 15.06, up 4 cents or 1/4%. One thing I like to note about precious metals, I've been covering sometimes the Commitment of Traders report, the CFTC report, that is published Friday afternoon, 3 p.m. New York time. As last week, we had a public holiday, the 4th of July. As the CFTC is a government agency, they delayed the publication by 1 business day. So that number came out yesterday for gold and silver. The commercials in gold are continuing to increase their short positions. They increased it by a net of over 26,000 contracts. So now they're 447,104 short and 160 long. That means they're trying very hard to get the market to turn, and they could do that in the short term. Still of the belief, of course, that gold has broken out. I think this is just a consolidation, of course, a breather. Silver commercials actually decreased their shorts actually by almost 6,000, and they decreased their longs by 4,473. So net, they actually went slightly long in silver, the commercials. So that was out yesterday, actually at 3 p.m. New York, not last Friday. So what about the rest of the markets? The Dow right now, Dow futures down 104 or 0.4%. S&P 500 is down 12, and the NASDAQ 100 is down 53, almost 2/3%. Currency-wise, we've got the pound continue to drop. We're down 30 pips or 1/4% below 125. It's at 124.88. The euro is unchanged, 112.10. Dollar yen unchanged as well, 108.74. And the dollar is down about 0.1% against the Chinese yuan at 688.22. So what's going on right now? I'm reading a lot of headlines and stories to the effect that because of the strong numbers on Friday for non-farm payroll, that rate cut hopes are fading, or even like in July, I think the hope now is of a 25 cut, not a 50 basis point cut. I think it just goes to show how the Fed is cornered, because they need to cut rates to keep the stock market elevated. But if you keep getting numbers that aren't too bad or are even better, how can they justify the cut, right? WTI is at 57.50, down about 0.2%, and Brent is at 63.82, down also 0.2. So crude oil is fairly steady these days. The bond market, yeah, the 10-year yield is at 204 right now. So it actually hasn't gone further down, which is interesting. I would have expected it to drop with the stock market lower this morning, but it hasn't. The 3-month T-bill yield is actually at 225, so that's crept up a little bit. So we're still inverted about 21 basis points, but the 3-month yield has risen. We've been around 221, 222, so that's risen a little bit. So China and their gold purchases. I saw an interesting article on Zero Hedge this morning. It says China officially buys gold for 7th straight month as Treasury holdings tumble. The other interesting thing about what China's been doing, and you can see by the little chart here that Zero Hedge puts here, they've actually been telling or publicizing that they're buying gold. In the past, they used to buy gold on the quiet, and then a year or 18 months later, or maybe even longer, they used to announce what they did. But now it looks like they're announcing it every month. And as you can see here, from, let's say, the end of 2016 till the end of 2018, they didn't add to any of their gold reserves. So this is quite interesting. So what does the article say? And I quote from the article. It says, China continued its renewed public gold buying spree in May, adding another 10 tons of the precious metal to its reserve, the 7th month of buying in a row. They go on to quote someone from TD Securities. It's a diversification away from the US dollar, particularly given the trade tensions and the potential technology Cold War that's evolving, says Bart Melick, global head of commodity strategy at TD Securities. And he goes on to say, we have to remember that gold is nobody's liability. Well, yeah, I've been saying that. There's no counterparty risk if you hold your gold. There is if you hold paper gold, like futures and ETF, of course. The article also notes that Alistair McLeod from Gold Money has been commenting, and he wrote in his last piece something interesting. They say one wonders if Alistair McLeod is onto something when he notes that if the yuan is to replace the dollar for China's trade, officials will have to back it with gold. Yeah, I've said that in the past as well. If China does want to encourage its main trading partners, and it does want to have the yuan as the currency for the One Belt, One Road initiative, it has to back it by something like gold, which most reserve currencies, major reserve currencies, have been backed by, even the dollar until 1971. I've been covering also the fact that China is making it easier for its trading partners, especially sellers of oil, to trade in Chinese yuan. They opened the Chinese yuan contract, oil contract, back in March of last year at the International Energy Exchange in Shanghai. I covered that a lot. I think that's a big step towards this process here that we're seeing. And so that's what Alistair MacLeod says here, and I quote, "For China, a gold exchange yuan standard is now the only way out. She will also need to firmly deny what Western universities have been teaching her brightest students." Yeah, that's all the Keynesian claptrap. That gold is the gold standard is a barbarous relic, like Keynes said, right? But if she acts early and decisively, China will be the one left standing when the dust settles. I think what he means by the dust settles, when the system implodes, the whole house of cards, and the rest of us in our fiat financed welfare states, I would also add welfare warfare states, will be left chewing the dirt of our unsound currencies. Totally agree there with Alistair MacLeod. So they end the article here showing a chart of China's monthly gold reserves versus U.S. Treasury securities holding. And you can see here how the gold holdings is actually on the way up and the Treasury holdings is on the way down. Just to finish, a quick look at this article about leverage loans. And what are leverage loans? They're basically loans to smaller companies that don't have a track record, mainly private companies. And it's mainly done via private equities. They're the ones who, how can I say, arrange these loans. Banks are doing these loans. And it's becoming a huge market, and it's not very regulated. And it's grown quite a bit. It's grown into a 1.2 trillion market of leverage loans. So what the FT is saying here, Doc Light, the new menace in 1.2 trillion leverage loan market. Private equity owners are withholding vital information from loan investors. So the article just goes on to say that I would say they're not investors. They're lenders, really. There's a difference, but the FT is calling them investors. They're being withheld financial information of the companies that they're lending money to for longer and longer periods of time. So I'll just go through this paragraph. It says, but despite the lukewarm interest, the Canadian software firm owned by KKR, the Wall Street private equity giant, still managed to include terms in the loan that gave it extra time to update its creditors with vital financial information. According to people familiar with the deal, investors will be left waiting up to 120 days for the company to deliver its annual report, up from the usual 90 days, with an extension to 150 days for the first year. The sort of delays are not unusual, signs of a new tension between borrowers and lenders in the $1.2 trillion market for U.S. leverage loans, which involves lending to riskier, lower-rated companies, often backed by private equity. So this is another thing that I covered. I think it was in November. The Economist covered that, and then recently we've heard central bankers, I think like Mark Carney of the Bank of England and even Jerome Powell, note that these kind of loans could be troubling for the overall health of the financial system, even though, as usual, they say, oh, it's too small to affect it. A little bit like Bernanke said that the subprime crisis was contained and it wouldn't spill over. So I think we need to keep an eye on that. Maybe this is the credit default swaps of the 08 crisis. This is the, the leverage loan is something maybe more people are going to be talking about in the future. We'll have to see. So here's how much it's increased, the leverage loans. I mean, it's grown quite a bit in the last few years, as you can see. So China continue to buy physical gold. I would rather do what they're doing than what the Fed's doing and the U.S. government is doing, increasing more and more the deficit. Does the U.S. really have that much gold left, at least unencumbered? or leased out to bullion banks. I don't know. If you enjoyed this video, make sure you hit the like button, subscribe to the channel if you haven't yet. You can also follow me on Twitter, Steemit, and on DTube. I wish you all a great day. Take care. Bye.